Every single investor, whether you're a pro on Wall Street or just getting your feet wet, you face the exact same puzzle. How do you go after those big returns without taking on a terrifying amount of risk? It's the ultimate balancing act. So today, we're going to break down a framework to analyze that exact challenge, using some real-world stocks. Okay, let's get into it.
So to make this real, let's look in three totally different companies. First, you've got the electric vehicle pioneer, Tesla. Then there's the global coffee behemoth, Starbucks. And finally, a smaller, more specialized player, the air cargo company Air T. Now, if you had to put your own money into just one of these, which one would you pick? Seems like a simple question, right? But the smart answer is, well, it's anything but simple.
And that's exactly what our mission is here today, to build that framework. We're going to give you a simple but really powerful toolkit using data from our source analysis. The whole idea is so you can stop just guessing and start making a truly informed decision.
So here's our game plan. First, we'll start with a basic trade-off between risk and return. Then, we're going to look back to see how these stocks have actually performed in the real world. After that, we'll look forward and try to predict their potential. Then, we'll explore the power of pairing them up. And finally, we'll wrap it all into your brand new investor toolkit.
All right, first things first, the absolute core principle. The entire world of investing, it really just boils down to this one relationship between risk and return. You absolutely cannot evaluate one without understanding the other. I love this slide because of its beautiful simplicity. The source material just nails it. This right here, this is the goal. For pretty much every investor out there, the whole game is trying to find investments that get you as close as possible to this ideal: maximum reward for minimum drama.
Okay, so let's get to our first set of tools. To even get started, we have to look backward. By digging into the historical data, we can get a really clear picture of both the rewards a stock has given investors and just how bumpy that ride has been.
We're going to use two key metrics. First is the average or mean monthly return, which tells us, the typical reward you would have gotten. Second, we'll use something called standard deviation to measure the risk. Now, don't let the term scare you. Seriously, just think of it as a number that shows how much a stock's price tends to swing around its average. Higher number, more drama. Simple as that.
Okay, so here's the data for our three stocks laid out right next to each other. Your eyes probably go right to Tesla, right? A whopping 4.55% average monthly return. That's fantastic. But look right next to it. Its risk, or standard deviation, is also the highest by a long shot, at over 16%. Starbucks, on the other hand, well, it had a slightly negative return during this window, but with way less risk, and Air T is kind of sitting right there in the middle.
A great way to wrap your head around this is to think like you're building a sports team. Tesla? That's your superstar striker, capable of scoring these incredible game-winning goals, but, can be inconsistent and sometimes just has an off night. Starbucks is your reliable defender. Not as flashy, not going to be on the highlight reel, but incredibly consistent and predictable, game after game.
And this slide right here shows you what that means in actual dollars and cents. Based on its standard deviation, a typical month for Starbucks could land you somewhere between a 9% loss and a 9% gain, a pretty defined range. Now, look at Tesla. A totally normal month for them could be anything from a nearly 12% loss all the way up to a 21% gain. That is what we mean by a wild ride.
Okay, looking back is really useful, but let's be honest. As investors, we get paid for what happens in the future. So how in the world do we even begin to predict what a stock might return? Well, for that, we turn to a classic Wall Street tool called the Capital Assets Pricing Model, or KPM for short.
The secret ingredient in this whole KAPM formula is a little something called beta. All beta does is measure how a stock tends to move compared to the overall market, say the S&P 500. A beta of exactly 1 means it moves right in lockstep with the market. Over 1, it's more volatile. It exaggerates the market's moves. Under 1, it's less volatile. It kind of dampens them.
And here's the perfect visual for that. The source data shows Tesla has a beta of 2.07. What that means is, if the market goes up 1%, you'd expect Tesla to go up 2.07%. But, and this is so critical, that sword cuts both ways. When the market goes down, it goes down even harder. On the flip side, RT with a beta under 1 tends to soften the market swings, both on the way up and on the way down.
So when we plug those beta numbers into the CAPM formula, this is what it spits out for what we might expect as an annual return. And here's the key takeaway. The model projects a much higher return for Tesla precisely because of its high beta.
It's basically saying that for taking on all that extra amplified risk, you should be demanding a much higher potential reward. It's like hazard pay for your investment. All right, now we get to a more advanced and, I think, a much more interesting idea. So far, we've been looking at these stocks like you have to pick just one winner. But, truly smart investing is rarely about picking one stock. It's about building a team, a portfolio. And that's where this idea of diversification comes in.
So you're looking at that last slide and the obvious thought is easy. I'll just take Tesla with its 28% expected return and call it a day. But what if I told you that the smartest move might not be picking just one, but pairing two of them together to actually lower your overall risk?
To figure that out, we need one last tool, the correlation coefficient. It's just a number between -1 and +1 that tells us how two stocks tend to move in relation to each other. A +1 means they're perfect dance partners, moving in perfect sync. A -1 means they do the exact opposite. And here's the key. For diversification, for building a strong portfolio, you want a number that is as low as possible.
So let's look at the correlation data for our three possible pairs. You can see the numbers for Tesla and AirT and for Starbucks and AirT. But look at that top one. The pairing of Starbucks and Tesla has the lowest correlation coefficient of them all, at just 0.03. It's basically zero.
So what does that tiny little number actually mean? It means their price movements are almost completely independent of each other. And here's the big kind of counterintuitive takeaway. Your gut might say, oh, I should pair two safe stocks together. But the data shows the absolute best way to reduce your overall portfolio risk here is to combine the wild ride of Tesla with the steady ride of Starbucks. They're the ultimate odd couple. And because they don't move in sync, the big upswings in one can help balance out the downswings in the other, creating a much smoother journey for your money overall. It's such a powerful lesson. Sometimes in investing, opposites really do attract.
And there you have it. We started with a simple question, and piece by piece ended up with a pretty sophisticated analysis. So let's just quickly recap the powerful new tools we've added to your investor toolkit.
I mean, think about what you can do now. You know how to measure past reward with mean return and past risk with standard deviation. You can gauge a stock's sensitivity to the market using beta, and then use that to estimate future returns with the CAPM model. And, maybe most importantly, you now know how to use correlation to build a smarter, more resilient portfolio by pairing assets together.
This framework doesn't just work for these three stocks. You can apply these exact tools to almost any investment you're curious about. The goal today was never just to give you an answer, but to empower you to start asking better questions. So the only real question left is, what will you analyze next?